Many of you asked me about my opinion on the S&P 500, if it's undervalued, if it's overvalued, if the market's gonna crash, or if we're gonna rally to something like 6,000. You have a lot of people making either market crash videos or making pretty bullish calls that we're gonna have some kind of a Santa rally at the end of the year and we're gonna close at something like 4,500 or 4,800. A lot of people even have 5,000 as a target, which to me looks impossible. It's pretty interesting. 2023 has been interesting in general, with the fastest pace of rate hikes in history. The S&P 500 is up around 14% year to date. Now, what's even more interesting about the S&P 500 is mainly the Magnificent Seven outperformance. It has been absolutely insane. This does not happen every single year. It's pretty rare. And you could look at the Magnificent Seven stocks, which most of you are familiar with them. It's mainly Apple, Tesla, Nvidia, Google, Amazon, Meta, and a lot of those other names, the Magnificent Seven. They're up over 71% year to date, while the rest of the S&P, the 493 stocks, they're only up 7%. And if you compare them to the Russell 2000, the small caps, it's even worse. This is a chart I posted on Twitter. You could look at the IWM, which is the Russell 2000. The Russell 2000 is down 1.8%, while the Magnificent Sevens are up 71%. So it has been a massive outperformance. Without the Magnificent Seven, if they were pretty much flat, the S&P 500 would have most likely been down on the year. It would have been maybe at 3,700 or 3,800, but here we are sitting pretty close to 4,400. And many of you are asking, why is this happening? Why is the Magnificent Seven outperforming everything? And what could cause this trend to change? Because I've been personally buying everything outside the Magnificent Seven. I've been buying some large caps outside the Magnificent Seven. I'm buying some small caps, micro caps, Canadian stocks in the UK, mostly a lot of Canadian stocks and plenty of other things that are just outside the Magnificent Seven. I've been finding amazing opportunity, but yet the Magnificent Seven stocks, they continue to go up while everything either goes down or stays flat. And I'm going to tell you in this video when I believe this trend is going to reverse and why is it even happening. In my opinion, it's happening because of the rate hikes. We're pretty close to 5.5% in terms of the federal funds rate, and these mega cap companies are safer than the smaller caps. They are more, nationwide. They're even outside the United States, so they have, much less exposure to the rate hikes than just the tiny small cap Russell 2000 companies. This is why the Russell is down 1.8%, while the mega caps are up something like 73%. Even though the mega caps are dependent a lot on advertising, but they are better positioned to handle the rate hikes than smaller companies. They have much more resources, much better management, much better access to funding and capital markets. So I believe hedge funds are going to Google and Apple and Amazon for safety. But this is why the Magnificent Seven have been propped up so much. The second reason they have been going up and performing so well is because these companies have amazing balance sheets. The rest of the S&P, the 493 stocks, the Dow Jones kind of stocks, even the small cap stocks, they do have a lot of debt. A lot of this debt is variable interest rate. It's not fixed. So a lot of these companies are suffering on rate hikes. But you have the Magnificent Seven stocks with amazing balance sheets and amazing cash positions. Something like Google. Google has over something like $118 billion of cash. Amazon has $64 billion of cash. Microsoft has $111 billion of cash. Now imagine, if they're putting it in short-term treasuries, collecting 5 or 5.5% on $100 billion, this is like $5 or $6 billion every single year just from interest on their cash position that's just sitting and doing nothing with little to no debt. I mean, this is amazing. This is one of the reasons why they've been just performing so well. You even have Meta. Meta has $53 billion in cash and cash equivalent. Nvidia has $16 billion. Tesla has $23 billion. And the Big Apple has $62.5 billion of cash. It was a little bit more, but they're doing some investments, buying back stocks. So it's $62.5 billion. These are massive cash positions, and they are benefiting a lot from much higher interest rates. Now, in my opinion, the way I think about it is if I'm right, and this is the reason why investors and hedge funds are rotating to safety into the mega caps, whenever interest rates come down, I believe the opposite's going to happen. I believe the Magnificent Seven are going to start coming down, and this might cause investors and hedge funds to starting to speculate in the 493 stocks, or even speculate in the Russell 2000, where I own a lot of companies, because rate cuts and lower rates are good for the small caps, but they're not so good for the mega caps, and there's no reason to run for safety. So this is what I believe is going to happen. I believe they massively outperformed because of higher interest rates, but whenever interest rates ultimately go down, I would personally be betting on the opposite to happen. I would be betting on the Magnificent Seven to start coming down, and for the IWM, Russell 2000, and the rest of the 493 stocks where I'm invested in, I would expect these stocks to start outperforming the Magnificent Seven, and we're already seeing some of this actually happen. Now, if you look at the S&P 500's PE ratio with much higher interest rates, it's sitting at 25 times. Now, that doesn't make sense. A lot of you would say it doesn't make sense, but we have said it for a while, and it's just S&P keeps going up. This is for a very good reason. Maybe an amazing lesson that we learned in 2022 and in 2023 is that the market is not really driven by valuations anymore. Maybe this was the case before 2008. But after 2008, if you look at the Fed's balance sheet and the S&P 500, you could look at the close correlations. The blue is the S&P 500, and the dark is the Fed balance sheet. Whenever the Fed balance sheet expanded, the S&P has rallied. Whenever it has stayed flat or contracted, we had pretty big crashes like the late 2018. Apple went to 13 times earnings. Google was trading at 15 times earnings, I believe. I know I bought Apple and then I sold it. It was a mistake. But it was just amazing deals, and we had many such opportunities whenever the balance sheet is contracting. Then we had the massive post-COVID recovery whenever the balance sheet expanded. So the market is mainly driven by liquidity instead of just valuations. And if we look at a recent chart of liquidity, this is what happened in SVB. This is why I got bullish on SVB, because I learned my lesson. I learned that it's not much about valuation, it's more about liquidity. And whenever the Fed said that they're going to intervene, this is when I started buying a lot of the NASDAQ stocks like CrowdStrike and many other just speculative names, and I made a lot of gains on that stuff. I was late to buy in the market. I was sitting on some cash because I was bearish in January. But then I had an opportunity to correct my mistakes and going long in the market whenever we had the SVB. People were calling for a 2008, but the market already looked beyond the whole financial crisis and beyond the banking problem just because they're going to have more liquidity. And this is the key here. And if we look at the latest chart of this liquidity index, which I'm not sure if I can trust, I found this on Google, but it has been increasing, which means the S&P is most likely going to go up. And if we have more liquidity injections in the future, the S&P is going to go up, even though if the PE ratio is 25 times or 22 times or 26 times. It's sad to say, but this is what happened after 2008. The market got messed up, and I don't think it will ever get back to what it used to be. It's pretty sad, but it's just the way it is. Now, on the other hand, you have history telling us that most of the declines actually happen after the Fed pivot. So, for example, the Fed pivoted in something like in early 2000, then the S&P went down 51%. They pivoted in 2008. The S&P went down 58%. They pivoted in March 2020. The S&P went down 35% after the first rate cut or after the pivot. But now, they have not pivoted so far, and it will be interesting to see what happens, next year. But in the near term, pretty much the way I'm looking at it, the way I'm seeing it, I'm seeing a pretty strong trend line that I've been watching. I made videos before in early 2023. I said, as long as we don't go below this trend line, I'm not personally worried. I'm not personally shorting the market if we're still above the trend line. And now we're still above the trend line. I would personally expect maybe us to touch it again around 4,000 or 3,950. I would not expect the market to go below 3,900. The trend is pretty strong. Unless we break the trend line, then, we would have some kind of a liquidity event or something crazy. But if everything stays the same, I'm personally not seeing the S&P going below 3,950 or maximum 3,900. This is what I'm saying on technicals. This is what I'm saying on the liquidity chart. And it will, remain to be determined. But this was my general opinion on the Magnificent 7 outperformance and the S&P 500. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.